All right. I'm freaking done with it. I can't freaking stand when I see these videos and these people are just 100% incorrect. And they're going to screw a lot of people over because people are actually watching this stuff and thinking that is how it is. So I'm about to expose these freaking infinite banking idiots. And my last video, I did this, but I have 2 more today. And I got to get it off my chest. So here's the first one.
Banking. If you haven't, you're definitely going to want to keep watching this. You don't want to put your money in a 401k or an IRA because your money is in money jail. You can't touch it until you retire. But if you put your money in a whole life insurance policy, you get even better compounding interest than you would in a 401k or an IRA. But you can pull your money out whenever you want and use it for whatever you want, pay no penalties, and it's uninterrupted, so you're still collecting interest on that money like you never even pulled it out. So like a quick example of why you should get it. Let's just say that you want to become a real estate investor. You want to buy a duplex. You pull your money out of the whole life insurance policy. You're still collecting 8% to 10% interest on that. And then you buy the duplex, and now you're making interest on that. So now you're getting double interest. It's a no-brainer. Follow me for more, guys.
All right. Quote him, don't put your money in a 401k or a Roth IRA because you're putting it in money jail. If someone you're meeting with in finance leads with that statement, just freaking fire them. Because there's a circumstance for everything. But why would you not fund a 401k if you're getting a match? And why would you not fund a Roth IRA if you were able to? Instead, he wants you to fund a life insurance policy. And then he, quote, says, you're going to get better compounding interest in the life insurance policy. Wrong. It's freaking wrong. And this is why. The way this works on a life insurance policy, you have a participation rate, you have a cap rate. It's going to track an index. It's not directly invested in the market, but it's going to track an index, usually the S&P 500, but it can track other indexes. The insurance company, depending on which one it is going to have a participation rate, which means that, let's say the participation rate is 100%. That means that they're going to give you 100% of the gains up to the cap rate. If the cap rate is 10%, then you can get 100% of the gains, if it's tracking the S&P 500, 100% of the gains that the S&P 500 has with a maximum of 10%. If it goes up 20%, you only get 10%. Let's say the participation rate is 50% and it's uncapped. The cap rate is uncapped. That means that if it's tracking the S&P 500 and the S&P 500 goes up 30%, they're going to credit you 15%. Meanwhile, in the Roth IRA, if you had the S&P 500, you would get 100% of whatever the S&P does. Now, in life insurance policy, a lot of them have a floor, usually at 0%, so you don't have the losses. So that means if the S&P does negative 10%, then you get 0%. So while it may appear as though you can get better compounding interest, you don't, because one thing he didn't disclose is the fact that part or a good chunk of the money you're putting into it is paying for insurance. So it's not all being invested, for one. For two, if the policy does, let's say the market has 2 or 3 years of a negative downturn and you're getting 0%, the cost of insurance inside the policy is still rising. So you're not keeping up, your cash value is not growing high enough with the cost of insurance. If this goes on long enough, I've seen policies that were funded absolutely terribly and get lapse notices in a few years because you have dumb, I'm trying to keep it professional, because you have idiots like this guy that are funny, and he probably jacks up the insurance face amount so he can make his fat commission and doesn't even fund the policy right. The next thing, quote him, you can take the money out penalty free whenever you want, unlike a Roth or a 401k. You can access money sooner than a Roth or a 401k, yes. But where he's wrong is you can't access that money immediately penalty free. Because while it may not look like a actual penalty, like the 10% that the Roth or the 401k would have, you have two groups of value. You have your gross cash value, you have your surrender value, which means you can access the surrender value. The gross cash value is what you're earning interest on. This is if let's say you have $20,000 invested in the policy, that's your gross cash value. You're earning interest on the $20,000. But in the beginning of the policy, you may be only able to access maybe $5,000 of that or less. It's usually around year 15 or so when the accessible cash value meets the gross cash value and you don't have any more surrender charges. So yeah, you may not pay the form of a penalty, but you're going to pay a lot more in regards to what you're actually able to access. You cannot access all of that money whenever you want. It takes a while. Can the policies be good? Yes. I've done a lot of business in IULs, but the way that he is selling it is absolutely ridiculous. Let's move on to the next video. Oh, but I do want to go back and hit on this too. What he's talking about when you take a loan out and you keep earning interest on the money, he's talking about taking out what's called an index loan. When you take out an index loan, you have to pay the money back though. And you may be paying like a 4% interest rate. And if you're earning, 7-8%, then it's paying itself back. Yes, because if let's say you had $100,000 in cash value and you took the $100,000 out, the insurance company still earns, interest on the $100,000 in the policy. So because all you did was borrow against it, but it's locked up. You can't take more. You can't just take $100,000 out now, then take another $100,000 out. You can't do that. You can only take the money that's available. All right. And yes, while you are earning interest on $100,000 still, and you took the $100,000 out in cash, you can use it for whatever you want. You still have to pay the money back into it. The other thing is, as time goes on, the cost of insurance gets more and more and more expensive. And if you don't have the cash value inside of the policy still to keep up and cover at least the cost of insurance, let alone outpace it, you're in risk of it lapsing, especially if you take a loan out against all of it. They're not disclosing this though. Let's move on to the next one, because the next one is he's an even bigger idiot.
Did you know that the bank creates money out of thin air using the fractional reserve?
I'm going to show you how you can do the exact same thing legally. Now this is exactly what I did, so I know it works. So first, I got an equity line of credit on my primary residence. I borrowed against that equity line of credit for the max amount. I then took that money and funded an uninterrupted compound interest policy. I borrowed against that policy to pay off the equity line of credit. Now I've got all the equity back on the equity line of credit, so I can use that for whatever I want to do investments with. The money I used to fund the policy from the equity line of credit is still compounding in my policy like I never touched it.
If you want to become really wealthy, mimic what the bank does and become your own bank. To find out how to do that, just follow the link in my bio.
You can't fix stupid. His idea was to take a HELOC out, borrow against his home, and he'll have to pay interest on the HELOC, to fund a life insurance policy. Look, if he's talking about it on social media, then he's freaking selling it. All right? That means he's earning a commission. If I sold it to myself, I still get paid a commission on it. All right? He's just an idiot. Why would you borrow against your home to fund a life insurance policy, especially at his age, and especially putting it into a policy that you can't access the money immediately? You can only access a portion of it. He didn't. Let's say he was able to take $100,000 out of his house and he funded this life insurance policy with $100,000. He wasn't able to pull that $100,000 back out. Not within a year, 2 years, 3 years. He may have been able to pull maybe $20,000, $30,000, $40,000 out after the first year. But no way in hell was he able to pull all of it back out and pay the HELOC back and have a loan still earning interest. So that's very misleading. He may have taken the money that he got from his fat commission from doing a large dump in to pay off the HELOC and then had this cash value building up in the life insurance policy, maybe. Or he took whatever he could out of the life insurance policy to try and pay off a portion of the HELOC. And yes, it still would have, that money still would have been earning interest in the life insurance policy, but it's not liquid like that. It takes time. And the returns you're getting, as opposed to returns you would get in a Roth IRA or a 401k, it's not really a comparison because of the way that they act. It also depends on what company you go with. The other thing is let's say you're paying $500 a month into this. Depending on how healthy you are and how old you are and other factors, the cost of insurance is taking up a portion of that money every month. You have to pay for the life insurance. And if that policy lapses and you've taken this money out, now you have to pay taxes on the money you took out. So there's a lot that goes into this that they're not explaining. And I don't know what the big issue is with this whole, the banks do it. Who cares what the banks do? If you're worried as an investor what the bank's doing because you're mad that they're earning interest on the money you have in there, life's tough. It's business. But you're going to get way further ahead by doing it right and researching this stuff and not listening to these idiots. And I just feel like it's my fiduciary duty to just expose idiots like this. I could go on and on and on. I could even I know these policies like the back of my hand. And it's just hard for me to explain it in words and try to keep it within a short video. But there's a lot more to these too that they're not talking about. All right. And it's not just so simple. So remember, if he's talking about it on social media, then he's selling it. All right. He's not talking about what he did, that some other agent sold to him. Why would he care? He's trying to sell it. He's trying to pitch it, and he's not doing a damn good job at it. It's horrible, and he's going to rip someone off. Like, this thing has 2,000 likes on it. That means there's 2,000 people that actually agree with this. And I'm scrolling down the TikTok feed and seeing all these infinite banking things, and every one of them is an idiot. So please, do your own reading on it and get illustrations. Make them show you the illustration that they're running. They will have a ledger that shows you the cash value buildup and a ledger that's showing you the accessible cash value. Now, it's going to be what's called you're going to have a guaranteed value and then an unguaranteed value. The unguaranteed value is going to show you what their average returns are. The guaranteed value is what you're going to be about 2-3%, whatever it is. It's going to be very low. But the unguaranteed value is the unguaranteed value that policy may perform. Here's the other thing, and this actually happened during COVID. A great example, a company I did a lot of business with had an 11.5% cap rate. You could earn up to 11.5%, 100% up to 11.5%. When COVID hit and rates went way down, they were able to change that down to 10%, I believe is where they're at now, even for people that were already in the policy. Even the people that already owned life insurance policies that had this, they were able to drop their cap rates on it. So they can change these interest rates. So you're talking about a period of 40 years. A lot can change. It's not just set in stone when it comes to these IULs. And the cost of insurance is climbing in value steadily as you get older. So I'm not trying to down the IUL. The IUL is a good product when it's used properly. But the way that they're selling it is absolutely terrible. It's like borderline illegal almost, I feel like. But they're not held to the same standards I am. So, if you like the video, hit like. If you have any questions, if you have any concerns or any comments, reach out to me. I'll be glad to answer it. But, hit subscribe. But yeah, this has got me fired up, and this is absolutely terrible.